Financial news can seem like a foreign language. It's full of jargon and complex concepts, but understanding it is crucial for anyone who wants to be financially savvy. We'll focus on two key concepts: leverage and capital structure. These terms are essential for understanding how companies operate and make financial decisions. Let's break down these concepts into bite-sized pieces. We'll use relatable examples to make them clear and easy to understand. By the end of this journey, you'll be able to decode financial news with confidence. You'll be able to understand the implications of leverage and capital structure. Understanding financial news is like learning a new language. It opens up a world of knowledge and empowers you to make informed decisions. So let's dive in and demystify these important financial concepts. Leverage is simply using borrowed money to fund your business. It's like a magnifying glass for your profits and losses. Imagine you're starting a lemonade stand. You need $100 for supplies. You could use your own money, or you could borrow $50 from your parents and put in $50 of your own. Now, let's say you make $200 in sales. If you didn't borrow, your profit is $100, but if you borrowed $50, your profit is $150 after repaying the loan. See how leverage amplified your profit? But what if you only made $50 in sales? Without borrowing, you only lose $50. With borrowing, you still owe $50, wiping out your entire investment. This simple example shows the power and risk of leverage. It can magnify your gains, but also amplify your losses. High leverage means higher risk, but also the potential for higher rewards. Understanding leverage is crucial for making smart financial decisions. Capital structure refers to how a company finances its operations and growth. It's about the mix of debt and equity the company uses. Think of it as the foundation of a house. Debt is like taking out a mortgage. You get the money up front but have to make regular interest payments. Equity is like using your savings. You own a piece of the house outright. Each has implications for control and repayment. Debt financing gives lenders no ownership but requires fixed repayments. Equity financing gives investors ownership and a share of future profits but doesn't require fixed repayments. Companies carefully consider the trade-offs between debt and equity. The right mix depends on factors like industry, growth stage, and risk appetite. Understanding capital structure helps you analyze a company's financial health and risk profile. It provides insights into its long-term sustainability and growth potential. Determining the right debt-equity mix is crucial for companies. It's a delicate balancing act. Too much debt can lead to financial distress, especially during tough times. Too little debt might mean missed opportunities for growth. Companies strive to find the sweet spot that maximizes returns while managing risk. Several factors influence this decision. A stable company with predictable cash flow can handle more debt. A company in a volatile industry might opt for more equity. Interest rates also play a role. Lower rates make debt more attractive. Ultimately, it's about finding the right balance for their specific circumstances. Understanding this balancing act helps investors assess a company's financial stability and potential for growth. It sheds light on the management's risk tolerance and its impact on potential returns. Section 5. Break-even point where the magic happens. Break-even analysis is a powerful tool for understanding leverage. It helps determine the sales level a company needs to cover all its costs. Imagine Cheryl starts a business selling posters online. She sells each poster for $20. Her variable costs, like printing and shipping, are $10 per poster. Her fixed costs, like website hosting and marketing, are $1,000 per month. Cheryl's break-even point is the number of posters she needs to sell to cover her fixed costs. To calculate this, we divide the fixed costs by the contribution margin per unit. The contribution margin is the selling price per unit minus the variable cost per unit. In Cheryl's case, the contribution margin is $20 minus $10, which equals $10. Therefore, Cheryl's break-even point is $1,000 divided by $10, which equals 100 posters. She needs to sell 100 posters each month to cover all her costs and start making a profit. Section 6, Guiding Decisions, the power of break-even. Break-even analysis isn't just about knowing a number, it's about making informed decisions. Let's say Cheryl wants to increase her profits. She could raise her prices, or she could try to sell more posters. The break-even analysis helps her understand the impact of each decision. If Cheryl raises her price to $25, her break-even point drops to 67 posters, rounded up. However, she might sell fewer posters at the higher price. If Cheryl focuses on marketing and increases sales to 150 posters at the original price, her profit jumps to $500. The break-even analysis helps Cheryl weigh the risks and rewards of different strategies. It empowers her to make data-driven decisions to achieve her business goals. Section 7. Financial leverage, the debt magnifier. Financial leverage focuses specifically on how much debt a company uses to finance its assets. It measures the impact of interest expense on a company's earnings. Think of it as a magnifying glass for the effects of debt on profitability. Let's say two companies, A and B, both have $1 million in assets. Company A has $500,000 in debt at a 5% interest rate. Company B has no debt. If both companies generate $200,000 in operating income, Company A's net income will be lower than Company B's due to the interest expense on its debt. Financial leverage magnifies the impact of changes in operating income on a company's earnings per share. A small change in operating income can result in a more significant change in earnings per share for a highly leveraged company. Section 8. Total leverage, the combined impact. Total leverage combines operating leverage and financial leverage. It provides a comprehensive view of how changes in sales revenue affect a company's earnings per share. It considers both the impact of fixed operating costs and fixed financial costs. High total leverage means that even small fluctuations in sales can lead to significant swings in earnings per share. This concept is crucial for investors as it highlights the volatility of a company's earnings. It helps assess the risk associated with investing in a company with a particular capital structure. Understanding total leverage provides a more complete picture of a company's risk profile. It helps investors make more informed decisions by considering the potential impact of leverage on earnings stability and growth. Section 9. Knowledge is power, making informed decisions. Understanding leverage and capital structure is essential for anyone interested in finance and investing. These concepts are fundamental to analyzing a company's financial health, risk tolerance, and growth potential. By grasping these concepts, you can decipher financial news with greater clarity. You can make more informed investment decisions. You can assess the potential risks and rewards associated with different companies and their financial strategies. Remember, knowledge is power. By demystifying these financial concepts, you empower yourself to navigate the complex world of finance with greater confidence and make sound financial decisions.